So I think it's another great time for the guys who are joining from the other platform. We meet again for this session and the one in Zoom. So we are continuing with the topic of group accounting, of which I'm going to talk about key adjustments which are done in group accounting. I'm still under the introduction of group accounting. So I think you will be able to benefit a lot from those areas, because once you understand key adjustments in group accounting, there's nothing you can't do. There's nothing you can't do in group accounting. There's no question you cannot do in group accounting once you understand how you are supposed to deal with the key adjustments. And that is what I'm going to talk about in the next around 1 hour. So in the next 1 hour, I will be talking about the key adjustments which are done in group accounting. And this one is important in financial reporting and analysis and in the advanced financial reporting and analysis, because this is a common topic. This is a common topic. This is a common topic. So there's some notes I will be sharing as I explain on my whiteboard. At the same time, there is some notes I will be sharing so that we discuss in depth. So just give me 1 minute so that I set up everything, then we continue. So we can continue from this point. We can continue from that point. So I've said that what I'm going to talk about is all about the key adjustments in the group accounting. So the key adjustments in group accounting. So the key adjustments in group accounting. Key adjustments in group accounting. So which are some of the key adjustments in group accounting? So the first key adjustment in group accounting is concerning the aspect of that is unrealized profit on stock. Number one, unrealized profit on stock. Unrealized profit on stock. So we have the UPS. So the first one is UPS. So I will list all of them, then we interpret one by one. Number two is all about unrealized profit. So the unrealized profit on fixed assets. Unrealized profit on fixed assets. So the UPFA. Number three, I will be talking about revaluation gain. So the revaluation gain on the non-current assets. Number four, I will talk about dividends paid. Dividends paid, how they are supposed to be treated. So dividends paid by who? By the investee company. By the investee companies. Investees. The investee companies. So the investee companies. The number 5, I will talk about other key adjustments like intergroup owings, that is intergroup balances, or we have the owings, intergroup balances or owings. Number 6, I will talk about cash and goods in transit, cash and goods in transit, cash and goods in transit. Number 7, I will talk about the errors in the accounts, errors in the accounts, errors in the accounts. Now, I want we discuss one by one. We discuss one by one, starting from the first one. So I need your attention as we start now. Sorry for the Nini, sorry for, I think the mic. I think now you can be able to hear me.
Yeah.
Yes, you could have unmuted and notify me.
Be able to hear you.
Yes, I had muted myself by mistake. So I repeat, from which point? From the start of UPS. Huh? Is that correct, Maureen? I repeat, from which point? I think I muted myself from the point of UPS. Huh? So I can repeat. Sorry for muting myself. So I was talking about UPS. So when there's the aspect of UPS is whereby you find that there is one entity that is called the parent selling goods to the subsidiary, or there's a subsidiary selling goods to the parent. So on this scenario, you will find that when goods are sold, let's say now from the parent, I was saying this is the parent. I was using an example of this one being the parent. and this one being a subsidiary, and this one being a subsidiary. So let's say the parent sold goods to the subsidiary at the selling price of 200, at the selling price of 200, making a profit margin of 20%. By the end of the year, in the books of B, you will be told that B never resold all the goods he received from A. You will be told, for example, he sold only a quarter, meaning that 3/4 is unsold. On this scenario, it means that there is an unrealized profit based on the goods B never resold. But for A, he made the total profit, meaning that the profit of A is overstated by what B never realized based on the goods which are unsold. So in consolidation, we don't allow profit overstatement in one entity which is not realized by the other. So meaning that we need to determine the unrealized profit on stock, which is unsold goods times the profit margin. Like now here we have 3/4 of the selling price times the margin. We get the answer, then we adjust accordingly. So I was saying, on some cases, you might be told that when A was selling the goods to B, he made a markup. So if you are given a markup, you need to change it to margin. So if the markup, if your profit markup is A over B, your profit margin will be A over B plus A. You need to add the numerator to the denominator. How do you eliminate UPS? Elimination of UPS from the books where it is overstated. So the elimination of UPS depends on what? Sales stream. It depends on sales stream. So if it's an upstream sale or downstream sale, that is. So if it was a downstream sale, this is how you eliminate it. Downstream sale. Because if it's a downstream sale, remember it was the parent who was selling goods to who? It was the parent who sold goods to the subsidiary. Like now, an example of this one. So meaning that the profit is overstated on the books of the parent. The profit will be overstated in the books of the parent. What am I supposed to do on that scenario? To eliminate this profit, like now, the profit I would have here, the profit which is overstated in the parent, which is unrealized in the subsidiary. So we need to eliminate it in the books of the parent. Which account will be affected? The profit account and the stock account. So for you to reduce your profit account, remember that you debit the group retained earnings account. Group retained earnings account is debited. You debit the group retained earnings account. You credit the group inventory account. Account. You credit that, the group inventory account. What about the upstream sale? What can you do? Let's say, for example, it was an upstream sale. What can be done? As I check with the online students here, so that I see if everything is okay. What if it was an upstream sale? Just a minute. So for the guys following online, if you are not in the live classes, you are welcome to join. Remember, other than these sessions I'm doing live, for the guys following online through YouTube, I do online classes in the evening. That is where I have most of the students attending. So you are welcome to join my live classes. Right now, FR is on Wednesday and Thursdays, and advanced financial reporting is on Monday and Tuesdays, 8 p.m. to 10 p.m. I think that is more convenient time. You have my number. I can even mention it here as we continue. This is my number. Whoever would like to communicate to me after this session, use this number to join my live classes. to join my live classes. The Zoom online classes, where we cover everything from the first topic to the last one. Anyway, for now, I was talking about UPS. I was talking about UPS. So we have said for the UPS, we can have a UPS based on downstream cell and upstream cell. So when there's this aspect of a downstream cell, that is from the parent to the subsidiary. Remember, the profit will be overstated in the parent. Like now, I used this example. So this profit, which is unrealized by the subsidiary, is overstated in the parent. So we need to eliminate that profit under the parent by debiting the group retained earnings account and crediting the group inventory account. So what if it was an upstream cell? What if it's an upstream cell? What if it's an upstream cell? What if it's an upstream cell? So upstream cell is whereby now, let's say it's the subsidiary, not let's say, it's where the subsidiary, the upstream cell is whereby you find that it's the subsidiary which was doing what? Selling to the parent company. It's the subsidiary which was selling to the parent company. So on this scenario, let's say now, on this scenario, I use a practical example. A practical example here. On this scenario, you would find that we have A, which is the parent, and we have B, which is the subsidiary. Let's say B, subsidiary. B is a subsidiary. On this scenario, you find that A received goods from B. So meaning that B sold goods to A, let's say at 120, at shillings 120, making a profit of 20% on cost, making a profit of 20% on cost. He made a profit of 20% on cost. He made a profit of 20% on cost. The selling price is this. He sold the goods at 120, making a profit of 20% on cost. By the end of the year, A never resold all the goods. A held, by the end of the year, A held a quarter of the goods in his stock, held a quarter. So meaning that when he held a quarter, that is what is unsold. That is what is unsold. He held a quarter. So meaning that he had sold 3/4. So a quarter is unsold. Then you are told to determine UPS. So UPS would be unsold goods times profit margin. So the UPS will be the unsold goods. UPS is equals to unsold goods times profit margin, times the profit margin. So in this case, unsold goods will be, they held a quarter, because that is what he never sold. He sold 3/4. He was holding a quarter by the end of the year. So he sold 3/4. A quarter is unsold. So a quarter of the selling price, which is 120, times profit margin. But this is not a margin. They are saying profit on cost. When you hear profit on cost, that is a markup. That is profit markup. That is a profit markup. So, and I said, when you are given markup, you need to change to margin. So the profit on cost is a markup. On cost is markup. So meaning that 20% is a fifth. So meaning that margin will be a fifth plus 1. You add the numerator to the denominator, you get 1/6. You get 1/6. So if you multiply 1/6, so you can be able to get your answer. So now, how do you adjust this answer in the books? How do you adjust the answer in your books? Because it was the subsidiary who was selling to the parent, meaning that the profit is realized here the total profit is realized, but it's unrealized here based on the goods which are unsold, their quota. So there's profit unrealized in the parent based on the goods he never sold. And these goods were received from the subsidiary. So meaning that the profit of the subsidiary is overstated. The profit of the subsidiary is overstated by what the parent never sold based on the goods he received from that subsidiary. So how do we eliminate? So here, 3 accounts must be affected. 3 accounts must be affected. The first one being retained earnings account, because we need to reduce the profit account, the group retained earnings account. Group retained earnings account. Debit, group retained earnings account, group retained earnings account, the group retained earnings account. Credit, group inventory account, group inventory account. Then again, credit, group, that is credit NCI account. Because on the subsidiary, you will find that the subsidiary was acquired, for example, 80%. So there's a 20% in the subsidiary which is unacquired by the parent. So meaning that, is it crediting the 2 accounts? Yes. So there's something more I need to confirm so that we make everything clear. Yes, 3 accounts must be affected. So this one so there's a mistake I've done here. So I have seen that. So here we always say that there's this debiting NCI account, then you credit, sorry for that, you credit inventory account, so that I explain how does this apply. How does this apply? So it applies this way. It applies this way. It applies this way. So you will find that, for example, let's have the answer here. So the answer for this is a quarter of 120 times a sixth. What do you have? So that I tell you how you apply this in the 3 accounts. What's the answer, Maureen? You are the one who can give me the answer. And the guys in the online platform, you can give me the answer in the chat.
The answer is 5.
The answer is 5. Here is 5.
Yeah.
So this, yes, now this one would be shared this way. So 5 would be shared this way. 80% of 5 goes to the retained earnings. I'm using the example whereby the parent controls the subsidiary up to 80%. So 80% of 5 goes to the retained earnings. 20% of the 5 goes to NCI. Then now the total amount of 5 is credited. The total amount of 5 is credited in the inventory. That is how you share that to the 3 accounts. Why am I having the NCI account? Because it's the subsidiary who realized the profit. The parent never realized the profit on the goods which are unsold, meaning that this profit is overstated here. And here we have the aspect of NCI, 80%. So we have to do what? We have to reduce that account. And at the same time, retained earnings account must be reduced and the inventory account with the total amount. So the 5 we share in the 2 accounts based on the percentage of control, that is 80%, then 20% for the NCI, and the total amount is credited in the inventory account. That is the correct way to account for that in case where you have an upstream sale. That is it for UPS. Once you know that, you can be able to adjust and realize profit on stock in group accounting. So it's all about understanding, is it an upstream sale or downstream sale? Another thing, the profit they included on the goods they sold, it is on markup or margin. When it's on margin, that is direct. When it's on markup, we need to change to margin. And you know how to change to margin when it's markup. So example is here. If it's a fifth, you say a fifth plus 1. So the one, which is the numerator, is added to the denominator. And it's not a must, they have to tell you that it's on a markup direct. They can say it this way, profit on cost. When they talk about on cost, that is a markup. We move to the second adjustment. Maureen and the others, you are allowed to ask any question before I continue to the second adjustment. Before I continue to the second adjustment, guys, any question?
Hello, Edwin.
Yes, I'm saying, do you have any question?
So if profit on cost is markup, margin is what?
On the selling price.
Oh, thank you. So far, I think it's clear.
Sawa. Again, we'll do questions. This is just an interpretation, but this interpretation is more important because once you understand this, you can be able to do any question. Any adjustments can be done because adjustments are the one which build a consolidation question. And for the online students from YouTube, I said whoever would like to join my class in the evening, that is where I do most of the classes, and that is where I have number of students. This is my personal number because not all sessions I will be putting live in YouTube. If you could like to join and cover the syllabus from scratch to the end, this is my number. So let's continue to the second adjustment, that is unrealized profit on fixed assets. Unrealized profit on fixed assets. So at the unrealized profit on fixed assets, unrealized profit on fixed assets, I will be using the word UPFA. So this one is whereby you find that there is an intergroup sale. It's supposed even to be an intergroup transfer of fixed assets. Intergroup transfer of fixed assets at a profit. So intergroup transfer fixed asset at a profit. So this is whereby you find that the parent has transferred a fixed asset, like plant, to a subsidiary at a profit. So the asset is not supposed to be transferred at a profit. So meaning that it's like he made a sale. It's not on fixed asset, the parent is not supposed to make a sale to the subsidiary. So on that case, if there was that intergroup transfer of a fixed asset from the parent to the subsidiary at a profit, obviously the subsidiary will never resell that fixed asset. Like now if we have A and B, parent subsidiary. A transferred a fixed asset to B at 200 million, making a profit margin, let's say 20%, 20%. So on this now they will go silent. They will never tell you that B sold or unsold. It's upon you to know that the subsidiary will never resell the fixed asset. So meaning that he will never realize the profit with the parent realized, because this subsidiary is not supposed to be resold by the subsidiary, but to be used for the business purposes. But remember, the parent transferred that fixed asset to the subsidiary at a profit. So that profit which was realized by the parent will never be realized by the subsidiary, meaning that there is a profit unrealized by the subsidiary, but realized by the parent, meaning the profit of the parent is overstated. And the rule in group accounting is that we don't have to expect a profit overstatement in one entity due to the profit which is unrealized by the other. So we have to do an elimination of that overstated profit. How do we do that? So UPFA is equals to the value at which the asset was transferred, transfer value times profit margin. Transfer value times the profit margin. Transfer value times the profit margin. So in this scenario, like now it's 200 times profit margin over 50, I will be able to get 40. So this 40 is overstated in the parent because B never resold the fixed asset. B never resold the fixed asset. So we need to eliminate that profit in A. How do we eliminate a profit? I said we debit. Obviously, when you are reducing your retained earnings account, so you debit the retained earnings account. Group retained earnings accounts is debited. Group retained earnings account. We credit what? The property, plant, and equipment account. The property, plant, and equipment account will be credited. Then after this, the next immediate thing to do in this intergroup transfer of fixed asset is to go ahead and check if they were charging depreciation on the fixed asset, of which you will obviously be told when there's a transfer of a fixed asset which is a depreciable other than land, which is a non-depreciable. When there's an intergroup sales of a fixed asset which is depreciable, you will obviously be told that there was depreciation on the fixed asset. How will they test that? You will be told right now here, A sold a fixed asset, that is plant. A sold a plant to B at 200, making a profit margin of 20%, full stop. Then they will say the group charges depreciation at the rate of 20%. The groups means both two companies. They were subjecting the same asset to a depreciation at 20%, meaning that both the parent and subsidiary during the intergroup sale, during the time they were holding that asset, and remember they intertransacted, they charged the depreciation of the same asset. They subjected the same asset to depreciation, both of them. And that is wrong because they did a depreciation overcharge. And that one implies that they understated the value of the asset. So we need to determine the depreciation overcharge and eliminate and adjust, sorry, not eliminate, and adjust back to the value of the asset because they did what? They understated the value of the asset. They did a depreciation overcharge. Doing a depreciation overcharge, they understated the value of the asset, and at the same time, they understated the profit. So meaning that you have to go ahead and check what? Check for depreciation overcharge, deep overcharge, of which this one, how would it be done? You take your UPFA, and realize profit on fixed asset times depreciation rate, times the depreciation rate. Or if you are given the remaining useful life, you take your UPFA, you divide with the remaining useful life. Remaining useful life. Like now here we have a UPFA of 40. Let's say if you are told that the group charges depreciation at the rate of 20%, so I could have multiplied 20%, I get my 8. So this 8 must be adjusted in the books. How do you adjust in the books? The 8. How do you adjust in the books? The 8, because the 8 is now the depreciation over. Meaning that this one understated the value of the profit and at the same time, the value of the asset. Meaning that for us to correct the understatement of the asset account, we debit the PP account because we are adding back the 8. Debiting is adding. Then again, we add back this to the retained profit account. Retained profit account. The retained profit account. That is it. So what you need to know, or what you need to put into consideration when you are dealing with the unrealized profit on fixed assets, is all about how do you determine UPFA and how it's adjusted, the unrealized profit on fixed assets, how it is adjusted, how do you determine first, and how it's adjusted. This is the way you adjust. Then how do you determine depreciation over change? How it is adjusted, and this is how it's adjusted. You debit and a credit there, and a credit there. That is the end of this second adjustment. That is the end of the second adjustment. Any question again before I continue?
I think all is clear. So just continue. Wacha niandike hii.
So I can see for the guys who are online, YouTube, who needs my number, I can see there's someone who is saying he needs my number. I have shared my number earlier. Again, I can share here. This is my number for the guys who needs my number. 0728 760 546. Or I can share to you through the chat as one of our students takes the notes. So I've shared the contact. It's 0728 760 546. Maureen, are you done with making notes? And maybe for the others, you can say something in the chat. And remember to share these to your friends to join. Share to the groups. Subscribe again to my channel. You cannot be following without subscribing. You have to subscribe. Do the humbleness of subscribing and opening the notification bell. You are done, Maureen? I think yes. So we continue with the third adjustments. So we talk about next revaluation gain. Revaluation gain in the books of the subsidiary. In the books of the subsidiary. In the books of the subsidiary. So that is my next adjustment. So Maureen, you can give it a try. What's revaluation gain? When we say that an asset has been revalued, what do I mean? What do
The
you
asset has. So revaluation gain occurs whereby the asset has been revalued, then the amount realized, not even the amount realized, say the value after revaluation is higher than the higher than the book value. Then we can also have a revaluation loss, whereby if a revaluation is done and the amount is lower than the book value, then we have a revaluation loss.
So I will be explaining more. So Abdi, make sure that you put 254 when putting that number, because you are saying that it's not working. So put 2547 287 6546. And I can see I have your number from my end. I will be able to chat with you later. But make sure you put this if you want it to work. So revaluation gain, revaluation gain. Revaluation gain for the assets is all about the difference between the fair value of an asset and its carrying amount. The revaluation gain, we say that there's a revaluation gain when the fair value is greater than the carrying amount. The fair value is the market value of an asset. The carrying amount is all about the net book value, the value at which the asset is stated in the books. So revaluation gain is all about just the difference, difference between the fair value, fair value, which is the market value, fair value, which is the same as market value, and the carrying amount, and the carrying amount, which is the net book value of an asset. So the difference, that is a revaluation. So I will only say this a revaluation gain, when the fair value is higher than, when the fair value of the asset is greater than the carrying amount. The fair value is greater than the carrying amount. And the vice versa is for the revaluation loss. So the revaluation gain is when the fair value is greater than the carrying amount. So in an exam scenario, they can twist this statement by saying that the carrying amount was less than the fair value. So that is a revaluation gain. If they say that the carrying amount of an asset is less than the fair value by 200. So meaning that is a revaluation gain of 200 because the carrying amount is less than the fair value by 200. So that is a revaluation gain. Or they can say the fair value is greater than the carrying amount by 200. Are we together? Or I'm making noise?
We are together.
Yeah. And for the guys in YouTube, I think you are okay. Abdi, if you need a teacher who teaches business law, I have a good teacher on that. You could get one. Abdi, let's chat after. Let's chat after this session. I can see you need the Zoom link. You want to join through Zoom. But equally, you are following what I'm saying here. It's the same thing I'm doing. So, how do you treat revaluation gain? So the revaluation gain, the revaluation gain, remember, it increases the value of the asset. So meaning that you debit PP account, you credit what? You debit PP, you credit revaluation. Maureen, make sure your mic is muted. You credit the revaluation gain. So you debit the PP account, credit the revaluation gain account. So that is with the revaluation gain. So whereby you will find that the fair value is greater than the carrying amount. Then, what does a revaluation gain lead to? The revaluation gain leads to depreciation under charge, because you will find that that figure the asset was revalued with, that figure the asset was revalued with has not been subjected to a depreciation. Because you will be told that, yes, the asset has been revalued by 200. I have given scenarios how they will test the aspect of revaluation gain. Let's say the revaluation gain is 200. You will find that, or you need to know that when you have a revaluation gain, when you have a revaluation gain, that revaluation gain has not been subjected to depreciation. So we need to determine, we need to know the depreciation which is inside that revaluation gain, so that we subject that revaluation gain to a depreciation. Then we adjust in the books. Then we adjust in the books. So here, the revaluation gain leads to depreciation under charge. Leads to depreciation under charge. It leads to depreciation under charge. So if it leads to depreciation under charge, how are you supposed to deal with that? So you take your revaluation gain, you get your revaluation gain times what? Times depreciation rate. Or you take your revaluation, you take your revaluation gain, you divide with the remaining useful life. You divide with the remaining useful life. You divide with the remaining useful life. So how do you adjust that one in the books, the revaluation gain? Because now that one had not been catered for. So for the depreciation under charge, so if we did a depreciation under charge, meaning that the value of the asset was overstated, and at the same time the profit was overstated. The profit was overstated. So to correct the overstatement of the profit and asset, what do we do to the profit? The retained earnings, we debit group retained earnings account. So you debit your depreciation under charge under the group retained earnings, and you credit what? Under the group PP. You credit under the group PP. So that is it for the revaluation gain. For the dividends paid by the investee companies, So for the dividends, we mostly focus on the dividends paid by the subsidiary. Dividends paid by subsidiary. We mostly focus on that. The dividends paid by the subsidiary during the year under consideration, so that we have a pre-acquisition period and post. Post-acquisition period. So what do I mean when I say we focus on the investee company? So there's an example I'm going to share on your screen. So give me like a minute, I share it. So there's an example I'm going to share on your screen. In a minute, seconds remaining. Let's get to that example. For the guys joining through YouTube, you can enjoy this more in the coming classes if you join my live classes. I don't share everything by then YouTube. I think now you have realized from some of these live sessions I've done. But in the Zoom classes, we do everything exclusively. You can join. You have my number. I have shared the number, which is 0728 760 546. So this is the example I'm giving out. So I've said that the main concern is on how to account for the dividends paid by a subsidiary company, which was acquired during the year. So you can see even you would be able to enjoy my lecture notes. I always share with the students the personal notes I use. So I have the dividends paid by the subsidiary means that we are mostly concerned with the dividends paid by the subsidiary if the subsidiary was acquired during the year. If our financial year runs from January to December, mostly I will be concerned with the dividends paid by the subsidiary during that period, let's say by September, so that we have a pre-acquisition period of 9 months and post of 3 months. So how do we treat the dividends in the pre-acquisition period and the post? So there's this example here. They are saying H Limited acquired 80% of S 1st October 2016. The two entities prepare their books on 31st December each year. S Limited paid first and final dividends of 320 on 31st December 2016. Required show how the above dividend should be accounted for. So what you can see from my notes, I can explain. It's not a must that we write everything in the whiteboard, because this is a financial year which runs from January to December, because they said the final dividends was paid on December. So meaning that our financial year was ending December. So it starts on January. So I said mostly I would focus on the dividends if the subsidiary was acquired during the year. So you can see H acquired S 80% on which date? 1st October, which is during the year. So 1st October there. So we have pre-acquisition period and the post-acquisition period. We have the pre-acquisition period and the post. So when recording the dividends, we need to focus on the pre and the post. Where does the pre-acquisition dividends goes to? The pre-acquisition dividends will affect your goodwill computation. The goodwill computation, here they are using the word cost of control. Cost of control is just an account used in the goodwill computation. So in short, what you need to know is that your pre-acquisition dividends will be used as part of net assets when computing goodwill. So they have shared the 320, 80% for 9 months. And for the post-acquisition dividends, they will affect the retained earnings account. They will affect the retained earnings account. You can see they have shared 80%, 320 has been shared for the 3 months, which is post. So this is the main concern, 192 and 64. 192 and 64. I think that one is creating an understanding to you. There's a meaning which has been created. Yes, Abdi, I can see you are from Somalia. That is great. That is great. I appreciate. I know I teach even students from Rwanda, Nigeria. Like now, the evening class, we have students from Rwanda, we have the students from Nigeria, we have the students from South Sudan. Remember all of those countries, they do CPA. Rwanda does our CPA. Sudan does that, Somalia. Even South Africa, they have that option of being CPA. Because sometimes back, I was having some students from South Africa. So Abdi, welcome to the platform and you will enjoy. Maureen, have you understood what we are doing here? And for the online students, have you understood? You can comment and maybe I will be able to know what you are thinking about. Anyway, so what you need to know under dividends paid by the investing company, which is the subsidiary, how you are supposed to deal with pre-acquisition dividends and the post. And these pre-acquisition dividends will only arise, I have said, on the scenarios whereby the subsidiary was done what? Acquired during the year. So let's say if the final dividend is paid by December 2022, Remember that our financial year runs from January 2022. So you will find that, for example, the subsidiary was acquired on October 2022. So that you have the 9 months pre, 3 months post. So right now they were telling us the dividends was paid by the end of the year 320. So we apportion, we apportion for pre-acquisition period and the post. And remember, you will be given a percentage of acquisition. On this scenario, let's say, for example, it was A who had acquired B, 80%. A who had acquired B, 80%. A who had acquired B, 80%. So I have said what we do when apportioning for the 9 months. So 9/12 times 320 times 80%. That one you credit in the goodwill account. So that one will be used as part of net assets. For the post-acquisition dividends, the 3/12 times 320 times 80%, you credit to your retained earnings account. Let's move to the next one, intergroup balances. This is whereby you find that there's an outstanding balances, madenico, between the parent and the subsidiary, and it has not been paid by the end of the year. So intergroup balances, the parent owes the subsidiary owes the parent, and the amount outstanding has not been paid by the end of the year. As a student, what are you supposed to do for that? For that scenario, the intergroup owings, intergroup balances. So intergroup balances. So intergroup balances. For the intergroup balances, when these are outstanding balances, which have not been settled by the end of the year, they are not supposed to be carried forward to the next financial year. If it was an outstanding balance in this year, by the end of 2022, that is the period when we are preparing our books. The amount is outstanding from the parent to the subsidiary. So the subsidiary is not supposed to carry forward the amount to the next year, but the amount will be eliminated by the end of that period when they are preparing the books. How are you supposed to eliminate such an amount? How do you eliminate such an amount? Eliminate by doing what? Eliminate by debiting which account and crediting which account. So when you eliminate an intergroup owings, you credit trade receivable, that is group trade receivable account, group trade receivable account, group trade receivable account. You debit group payable account, group payable account. That is it, that is it, that is it. There's nothing you need to know other than that. Elimination. We are done with this. Next one is cash and goods in transit. The cash and goods in transit. So for the cash and goods in transit, so let's start with cash in transit. Cash in transit. Let me start with the cash in transit. This is where you find that there is money which was supposed to be paid by one entity to the other, of which you will find that that entity has paid the money, but by the end of the year, when we are preparing the consolidated statements, the money has not been received by the other entity, that is the recipient. You will be told that the amount was received after some days, after some days. Let's say if our financial year runs from January to December, let's say that there was an outstanding balance of A to B. There was an outstanding balance of A to B. Let's say it was 100. The amount was outstanding from A to B. A is supposed to pay the amount outstanding. That is A owes B. A had paid the amount, but this amount was never received by December when we are preparing our books. So it was received January next year. Let's say this is 2022. The amount was received 5th January 2023. So what am I supposed to do with this amount which was outstanding? Yes, A had paid, but it was never received by December. It was received on January 5th. So what we do, this statement must be adjusted, even if the amount was received on 5th January 2023. What are we supposed to do with this 100, we record. Normally, we record. So how do we record? We debit cash, stroke bank account. We credit what? We credit trade receivables. We credit trade receivables account. We credit the trade receivables account. We credit the trade receivables account. That is correct. We are done with the cash in transit. I think I can move to the goods in transit. Goods in transit. Goods in transit. Goods in transit. So for the goods in transit, goods in transit, goods in transit, the goods in transit. When we talk about the goods in transit, this is whereby you find goods were sold by one entity to the other on a credit basis. You will find that the goods were sold on a credit basis. Let's say A sold goods to B on a credit basis. A sold goods to B on a credit basis. Let's say on January, our financial year runs from January to December. January to December. A sold goods to B. A sold to B. A sold to B. Goods on credit. On credit. But the goods were never received by December. Let's say our financial year is 2022. These goods which were sold by A to B on credit, they were never received by December. Let's say they were received by B on 5th January 2023. They were received on 2023. So what again I'm supposed to do here? I need to adjust my 2022 financial year with these goods, which were received some few days after the end of the year. Remember that the goods were what? The goods were on credit. The goods were on credit. So what am I supposed to do? Record them. Record them. Record. They were never recorded. How do we record? So the goods to be received, you debit group inventory account. Group inventory account is debited. Because they were on credit, I need to increase my group trade payables account. Credit group trade payables account. Group trade payables account. That is it. That is it. We are done with this. For the errors, you just correct where the errors occurred accordingly. Correct them. Correct. That is the adjustment in group accounting. Nothing else. Nothing else. Besides understanding how you are supposed to do goodwill, maybe. Anything. That's it. These are the major adjustments which you can find in group accounting. So what is remaining is maybe telling you now directly how you can apply these adjustments in the statement of profit and loss and the statement of financial position. There's a way I can apply them direct without opening the T accounts, without doing the T accounts. So what I was doing here is just creating a meaning, a practical meaning behind the adjustments which are done. We don't have to skip direct to how it's done direct in the statements, but you need to understand when I will be telling you right now, we need to eliminate intergroup owings. I don't have to go and draw a T account. No, I will tell you that the intergroup owings is deducted in the trade receivables and trade payables. If it's cash in transit, you deduct under trade receivables, you add under cash. So that is a direct way. So that direct way of doing those adjustments, the direct way, once you understand, the direct way of doing this adjustment is well expressed in the notes I will share to you, Maureen, and whoever who would like to join my Zoom online classes. These are the notes. These are the notes. All of this is well written down. All the things I've explained, they are well catered for in an express way, other than implied. So you can see. So this is the direct way. These are the statements, and these are the now this is a statement of profit and loss. Like now, when we go to the revenue, I will tell you what you are supposed to do. It's all about taking the parent plus subsidiary. You minus only intergroup sales. When we go to the cost of sales, parent plus subsidiary minus intergroup sales plus UPS on closing stock. Now you know how you do UPS on closing stock. Minus UPS on opening stock plus depreciation undercharge. You know what's depreciation undercharge? Then minus depreciation overcharge. If it's expenses, you just add the parent plus subsidiaries. Everything is well done there. And this one will be explained more when I will be doing a question. So I don't want to repeat things. I'm just mentioning what I will be doing again when I will be doing a question. What was important is, have you understood what is a depreciation undercharge? What's overcharge? What's revaluation gain? What's UPS? What is UPFA? So right now, PPE, I will be able to tell you add parent plus subsidiary plus revaluation gain minus depreciation undercharge minus UPFA plus depreciation overcharge. So now, what I was saying is that when I do consolidation, I don't open T accounts at all. The only maybe T accounts I can do is for retained earnings, only retained earnings and NCI. That is the NCI when determining the capital account. The capital, sorry. The NCI when I will be determining the capital of the minority shareholders. So YouTube students, because my life is coming to an end. YouTube students, this is my number. Join us in the next session. I will not be going live. If you would like to join my class, this is my number. This is my personal contact. You can use WhatsApp, you can call me, and you will join at a friendly price. At a friendly price. Friendly price, for now, I'm charging per semester. That is from this time until we do the exam. That is from now. What I will be covering, because it's the major topics from group accounting, partnership, published, financial analysis, all of those have not been covered. This is just the first major topic I have started with. For the entire work to be done, that is the entire syllabus, I always charge a friendly price, that is Kenyan shillings, 5,000 for the students who join live. Maureen, are we together? What we have done today? Because I was having other students here. Maureen is the student who was in Zoom live today.
Yes. Yes.
At least you have understood the adjustments which are done.
Yeah, so far, I think not that I think I will understand more when we do an illustration.
And so our first illustration tomorrow, it would be from September 2015, question 1.
September 2015, question 1.
Yes.
Okay.
A nice time, guys, and thank you for your attendance. Maureen, see you tomorrow. And the other guys, you are welcome. Use this number.